What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team, recently ranked #1 on Wall Street in the 2024 All-America Institutional Investor Research Survey. In today's episode, Stephen and I will be speaking with Danny Kirsch, head of Piper Sandler's options trading desk.
Danny, thanks so much for coming back. The last time you were here was pre-Liberation Day, and you had some incredible insights about what investors were talking about, what you were seeing in the marketplace, and the complacency that was out there. And I feel like we are once again at a point where the idea of complacency is coming up in markets.
And I think that's always sort of the case in market highs. We're at all-time highs, but it's always like, what does complacency actually even mean? And for us, it's a couple of things. One, realized volatility now is 7.5 the last 2 weeks, 9.5 last 30. And what that means is the market's moving basically 50 basis points a day. During the peak of Liberation Day itself, we were moving 2 to 3 to 4% a day. So that was obviously extreme fear. This is the opposite. And when realized volatility gets this low, there's a couple positive things that happen. So one, and this is something we've been talking about as a tailwind to this rally, is there's strategies called vol control strategies. And so what these do is add equity exposure based on past or realized volatility. So when realized volatility is low, they continue to add equity exposure. When realized volatility is high, they cut their equity exposure. They've been rebuilding equity exposure since Liberation Day. So that's provided a little bit of a lift to the market. Now, you can track this on Bloomberg, and we can see it's like they've basically bought back all of the equity they sold around Liberation Days. Now, we're not at extremes. Like this can continue because realized volatility is low, but it's very incremental. It's small. So if realized volatility picks up, now that there is some equity actually sell, that could be an event that causes more selling. It's what we call a mechanical selling pressure, and right now it's mechanical buying pressure.
Quick question, is that equity buying? Is it just index buying?
Yeah, I think it's just index, but then we think it's just index buying.
Yeah.
So it's basically they will cut equity exposure and buy more bonds. Right now, it's because realized volatility is low. It's similar-ish to risk parity, but it's just based on past realized volatility. So you can actually track these indices on Bloomberg, and the line will show their percentage of equity exposure, and it just basically looks the opposite of 30-day realized vol. So 30-day realized vol is high, this goes down, and vice versa. So you can kind of track where it's going. So there'll be incremental buying, but anything to change the tide, they become incremental sellers. And they sell a lot faster than they buy. So realized volatility picked up. And for instance, we have an event coming up August 1st. And the nice thing about working in options and having these zero DTE options, these daily options in the S&P, you can back out one-day implied moves. And last time I was on, we talked about Liberation Day. Nothing was priced. Similar setup for August 1st. I get that everyone expects the taco trade to play out. Trump will chicken out. The thing is, he hasn't really been chickening out. Like they've been raising tariffs on every country more so than the 10%. They keep going up everywhere, and there isn't really been deals. And Andy's had a good call, and he thinks there won't be deals, and there will be higher tariffs, and that's part of the plan. Greg Ip had an article in the Wall Street Journal a few days ago that Trump is winning the trade war. He's raising tariffs. That's what he wants to do. So the fact that nothing is priced or not much is priced for August 1st makes me think it's like we could sell off for a lot of reasons, but you're kind of getting this event as well.
Two questions. One, did you see the chart? I don't know if it's a CBOE that published it. Single day options are now like 75% of option volatility. It just goes up every month as a share of options.
So the zero DT, I saw the chart, it's as a percentage of S&P options.
Uh-huh.
So of all S&P options that trade, it's like 70-ish% or expire within 24 hours. And in that chart I've seen amongst all options, so like single stocks, you don't have daily options. You just have weeklies. At least for now, I think they're trying to list dailies and some of the more liquid underlying. You'll see today, like option volume is going to be very extreme because it's expiry, it's Friday. So today you do have zero DTE on everything because it's expiration. So, and every week now there's expiration. But for S&P, yes. Most options are daily. Everything else is either weekly or monthly.
So another question, you mentioned 30-day realized volatility is roughly 7%, you said?
It's 9.5 right now.
Sorry.
10 days,
Okay.
7.5, yeah.
Okay, so what's the all-time low in that, and when was that?
Oh, I mean, that's probably like the longest duration of low realized volatility was 2017. And that's where I think we had 1 or 2 1% moves the entire year. So that's not happening this year. Obviously, it can't because we've had some extreme moves. So that lasted for basically an entire year where we didn't move. And then the bill passed at the end of the year and we just kind of rallied. In 2017, it was a very low, super high, sharp year to own the S&P. That obviously can't be the case this year because we already sold off a ton. So yes, you could stay in a low volatility market for longer than expected. I think that's unlikely. You also had rates at 0% in 2017. This is not the case this year. There's just seems to be a lot more going on and a lot more potential surprises, not to mention we don't really know the impact of a lot of the policies so far, whether it be tariffs, whether it be cutting government employment, whether it be cutting Medicare, Medicaid, like all of these things we'll start seeing, but we just haven't seen yet. And right now, maybe we're in the like peak euphoria. And I think that's the other thing we're seeing as far as complacency, crowded short basket on absolute fire, higher beta on absolute fire. We showed a chart of like mega cap tech relative to unprofitable tech. That chart is collapsing, meaning unprofitable tech has been ripping, mega cap has been underperforming on a relative basis. Call put ratio, extreme. It seems like the fear is not being long enough right now, and things flip very quickly.
I would say that looking backwards and with perfect 2020 hindsight, are you that surprised that there's this much risk on and euphoria? Just looking at in the last 3.5 months, credit spreads have collapsed, right? That's where people get more aggressive. And after that's been going on for several months, as you've said, there are these vol control funds that are adding to the dry powder coming into the market, and people are just getting more and more optimistic, FOMO, whatever you want to call it. But clearly, market's not being driven by fundamentals. It's driven by these very bullish macro views.
Yeah, and I think you've also had some catalysts, right? Like that's what we're always looking at the option as catalysts. You had the bill passing. So that was like there was some, a little bit of concern that might not pass. You had all these crypto bills this week, and you can see like crypto, I think the crypto-like names are up 40% the last month. So there was a run up into it. And there's a continued run up. There's obviously this pressure on the Fed. And then oil's been tame. Like you had a spike and it's come off obviously very quickly. So you've had, plus to your point on credit spreads, it still seems like there's a lot of money out there to continue to like buy the market, buy the dip. And there's that underperformance, I think, concern. And then the last thing that we flagged, and I know you flagged, is July seasonally is a good month to be long. So I think that's also ties into this piling in. And we saw last year the same thing. S&P was actually up in July before August. We had that volatility event in August at the beginning of the month. And it started with momentum rolling over, and then you had a big volatility blowout. I don't think we'll have a similar August-like event where volatility VIX isn't that low yet. But what I do think you could have is just a market sell-off. I think you can give some of these gains back after, especially with expiry is today as of like July 18th. This is S&P expiry. VIX expired on Wednesday. And one of the reasons why like these post-expiration weeks can add a little bit of volatility to the market, people need to replace their hedges. So your hedges expire. That's the way options work. So oftentimes that the week after expiry or the week or even the Friday of, you have a lot of you start to see a little bit of increase in put demand because people need their new hedges. And the VIX all just expired in 2 days ago. S&P just expired. So you could see just by virtue of people adding puts, it could add a little bit of pressure to the market because when I buy a put, the seller of the put sells me a put and then they hedge via selling stock. So that can just add a little bit of incremental pressure to the market next week. And again, when you have the lightish volumes, a little bit of complacency and a massive short squeeze, it sort of could set up for, some volatility, a little bit of pullback.
Yeah. So we've had some positive developments. We've had really no realized problems. The market typically only reacts to realized problems rather than the wall of worry. And then we've got President Trump giving us forward guidance for the Fed.
Yeah.
Right. So what are you hearing from clients on that? Because it seems that everyone's kind of on the same page that this is just some Fed put or Trump put or whatever you want to call it, that no matter what problem shows up, it's okay because we're going to have lower rates down the road and a more dovish chair of the Fed.
Yeah, it's funny. The rumor, the thought is that he did draft this letter. He did say he's going to fire Powell just to see what the market would do. And you got a 1% sell-off. You got a massive rate steepener. I think the 2s10s moved 15 bips like immediately after this happened. So it kind of tells you gold rallied, dollar weakened. So it just kind of tells you lose this sort of, there's some faith loss in the market. The fact that equity sold off dollar, it's like, that's pretty bad. It's just like a sell US trade. That reminded me of Liberation Day. So that clearly influenced his decision-making. But we were talking about this earlier, the fact that if you're pressuring the Fed to cut when they don't need to, and we actually could start to see inflation pick back up over the next few months. And you saw, in the CPI report, like you're seeing goods are getting more expensive. The the tariff is having an impact. But if they start cutting, the long end's going to sell off. And I think that's why the steepener is such a popular trade. And it's fundamentally makes a ton of sense. If he does get pressure in a cut, I think the inflation fears will definitely be a big issue, and you'll get the long end to sell off. And that's when you start to see small cap and crowded shorts get obliterated. That's like when Russell starts to underperform, and that's when you want to get out of all these like super high beta trades. I'm not saying sell Qs because I don't know, you probably never want to sell Qs to me. Like it just never goes down. And if it does, it's a buy. But Russell goes down. Russell hasn't made new highs. Like I don't think we're, I think the Russell rallies happened. This isn't the time to like start getting super long junk.
Exactly. This is one of the themes we had in our video this week, just highlighting that you look at credit spreads, which again, I think is just a simple way to understand all of what you just said. They've collapsed and we're more or less back down to the, I don't know, call it the third percentile over the last 40 years. So yeah, this is not the time to be adding risk. Typically, it's the time to be trimming risk. And I agree, it doesn't have to necessarily be a big market sell-off or sell the Qs story. And one of the things I like to highlight to investors is that, all these things people are worried about, they look at the market and they say, oh, nothing's getting priced in. But I think that's not a great way to understand what risks are priced in, because risks always, 100% of the time, show up first in market breadth, in pockets of the market, in individual stocks, before they show up in the S&P 500, particularly over the last several years as there's been so much fundamental polarization. So yeah, I agree. I think this is a time that we have a bit of a contrarian tactical short-term call here. I do think inflation is going to keep going up. CPI measures will go up. I don't think it's going to be a huge spike. I don't think it's 2022, but I think it makes the call that we're going to get lower rates a little more challenging. It creates more of a tug of war. If CPI goes from 2.4 to 2.7, where it is now, to 3% to 3.2, maybe higher over the next 3 to 4 months, which is kind of what we see playing out. It's not a huge inflation problem, but nowadays everyone is so inflation sensitive that small changes get over reactions.
Yeah. And I'd say it's like the other thing, like I remember we had dinners before Liberation Day and we talked, and it's like, we don't necessarily ever say hedge for hedging's sake. Like that could be part of your process. You want to always be hedged. We look for catalysts, and there is a catalyst, and we think it is underpriced. August 1st is happening. And then you also do get another CPI print before August 15th expiry. And there's July, 30th or 31st is the Fed. So it's like, there's a bunch of catalysts coming up, not to mention earnings, which I think earnings tend to be, a lot of dispersion there. So that's not necessarily a reason for a sell-off, but you have some macro catalysts before August expiry, when the market is at highs, when vol is low. It's like not a bad time to hedge. It's not always a good time to hedge. You don't hedge when the VIX is 50, or if you're thinking about it, that's where you want to short S&P futures. You don't buy options. They buy options when VIX is low, when there's catalysts, and when we think those catalysts are underpriced. And that's the setup. It's very much like Liberation Day. It's a very similar sort of setup. And the other reason to hedge, and this is something I did in my PA 2 days ago, and this is probably why we're going to go down. I bought S&P June 2027 10,000 strike calls on the S&P. And my thought was, and Cantor, you can listen. Here is my thought on this. They just said they want private investment in a 401k. Crazy. Yep. That seems like, so it's like, so good. Retail can bag hold all this like private equity, like maybe overinvestment. And then 2, you have like, I saw an op-ed in Bloomberg that they're talking about the way to fix Social Security is to move it out of just treasuries into stocks. And I was like, Is this for real? Like if these two things happen, it's like, I'm okay as like my right tail hedge. By the way, these options, so it's a 2-year call. S&P's at 6,300. You need to rally like 50%, just to be clear, over the next 2 years. And they cost $5 on $10,000. So it's like, that's the trade. So it costs $5 to buy these options. Yeah. And that's just your right tail, like something like the lunacy, like happens. Mind you, SPACs are back. So that's the other side, but that's a 2-year trade. And that can still work even because you're getting long Vega. So that could still work even if volatility goes up a lot. I think those calls go up in value, actually, even if we sell off, because the volatility element, it's a very cheap call option on a vol basis. Anyway, that's your right tail. You're super crazy. Things are good. But I think very near term, for real, very near term, we're advising people, look at Russell puts, look at IWM downside, stuff like that, the smaller cap, higher beta stuff.
Makes sense.
Cantor, you can buy some of those. And Steven, you can buy a little of those in your PA. So I'll send you.
You want to offload them to me?
No, those are the hold. You're gonna what will happen. This is what I hope happens. Obviously,
you
get like they 5 bag on something, either a random 2% rally, or we sell off 5% in a day and volatility goes up. you sell half, and then you leave the rest. Knock on wood. Hopefully it's that easy.
What you were talking about right there, the kind of balance between the left and right tails. You talked about that last time you're on, and we've known you for years. I love that balance that you bring. So we talked about August and some of the potential risks ahead. What are some of the potential positive catalysts that you're talking with investors about?
Yeah, so some of the positives, basically creating more incremental buyers of equities. That obviously would be very good. The crypto bill, I think it's a deregulation in general. That's kind of why we've had this sort of bullish thesis around financials. Seems to be more insulated from tariffs. There is less regulation. Obviously, rates could become an issue. But if you get a scenario where the tariff revenue offsets some of the spending attached to the BBB and you can actually get the deficit down, maybe you get a long end rally, which I think would surprise a lot of people if the long end actually moved down meaningfully. I know it seems to be the most consensus macro trade, and for good reason, is a curve steepener.
Yeah.
And a lot of people think, well, whenever Powell's out, they're going to cut rates 100 basis points. You're going to blow it. That'll be the big steepener. So that's the way they talk about the trades is Z5, Z6 trade. So it's Eurodollar futures. And you want to be, I think it's, I'm not a Euros, I don't trade these, but I think it's like you're basically playing for a lot of cuts next year and not many cuts this year. I think 2 cuts are priced in this year and you're playing for many next year. And that's a big steepener. What if there's things actually kind of work out okay? Deficit moves down because tariff revenue is doing what it's supposed to. Spending is sort of becoming under control. You have this peace dividend as well. Hopefully the Middle East, we're through that, and we'll see what happens with Russia and Ukraine. So you have these incremental positives, and then you have a refi cycle. It won't be obviously a massive refi cycle, but it's something. And then you have this tailwind behind banks, and obviously the deregulation side is very apparent. The fact what's going on with crypto, what's going on with SPACs, I think there's been 200 launches of these, Bitcoin treasury companies or crypto treasury companies, where they just basically create companies to buy more crypto. So that I think is the bull argument. And then, the eco teams had a really nice call on the CapEx investment and, when does that show up, and who knows, and maybe you get some onshoring. I think it's maybe a longer term story, but we've certainly seen clients buying longer dated upside in things like an XLB, which is the materials, and XME, which is metals. A little more domestic focus and perhaps tariff winners also. A name like FCX, where you put tariffs on a lot of their competitors, could do well in that scenario. And some of the material names we like because they actually do build a lot of factories in the US, and that expensing could be very positive. And this is an area also that hasn't made new highs. It hasn't broken out to highs. And the charts are starting to look a lot more encouraging. Oh, one other catalyst for you, Stephen, as well. Next week, there is a AI summit where Trump is going to discuss, AI investment and what the U.S. is planning to do. So we've had buyers of semiconductor upside. We've actually been buying it all month. Part of it was on the crypto side, part of it was on this, and then part of it was he had the Pennsylvania event a couple of days ago, again talking about power generation and AI. So we've had near-term buyers of semi upside on the back of AI, and obviously see Nvidia breaking out, and stock is fortunately in our market cap, but it still has tailwinds. He just recently said that perhaps the U.S. will be able to sell into China. And that's another area where we've seen it's always difficult, but we're actually seeing a lot more interest in buying upside in China as well right now. Part of it is you see iron ore breaking out, you see coal breaking out, and you see there might be some softening as far as relations between the U.S. and China. One, we can sell chips, or he's allowing Nvidia to sell, the lower tier chips into China, AMD as well. And Besson said 2 days ago, August 12th isn't necessarily a deadline with China. He's like, we might push that out a little bit. So it seems like perhaps China has a trump card, no pun intended, with rare earths, and making the U.S. want to negotiate a little more. So we've seen some more call buying in China, which is always difficult. And I would say if you are buying calls in FXI and KWeb and A-share, when they start to work, start monetizing. It seems like it's just a tough place to make money.
Interesting. So one of the things we've all been talking about has been the run up in risk lately. So we're just talking about all these potential positives. Speaking with investors in the rally that we've seen, does it seem like it's fear of missing out, chasing, or is there optimism that risk could really hold in there and buying beta?
I think it's 2 things: fear of missing out, and I think it is still there. My understanding is we don't track this, but just conversations. Grosses went up, meaning hedge funds got invested more money, but also nets stayed the same. So I think some of what's happening is not even necessarily fear of missing out; it's fear of getting run over in your short book. So that's where we're seeing a lot of call buying and maybe junkier parts that are riskier. I don't want to say junkier. It's all, who knows? We might have flying taxis any day now, but riskier parts of the market. buying calls there because you're worried about your short sort of getting away from you. And so that's, I think, more so than anything. And I think where the other areas we're seeing call buying, I think it is more of there is a fundamental view. Maybe there are stocks that are cheap and there is like some tailwind on the policy side. So that's why I think we're seeing a lot more interest on financials specifically, because they actually like them. Although they are a little expensive on a valuation basis, there's enough tailwinds on the regulation side, and earnings were solid, and buybacks and whatever else, that like, okay, I'm okay owning a lot of these names. And I'd say on the tech side, names like Google, maybe there's a little concern that ChatGPT will take some of their market share, but still look cheap, keep crushing earnings, still invested. And it's like, if you like, I think there's still a lot of optimism around AI and being there. Like, we don't see people buying a lot of puts on Qs or like worry that there's going to be a huge tech sell-off. And maybe that's also, instructive. I don't think anyone expected like the DeepSeek story to happen. So, there's certainly we're not priced for much downside surprise right now. I mean, Cantor, you spent a lot of time seeing clients. I know you were in New York yesterday. Do you get the vibe? I mean, the people I speak to, I certainly get the vibe that people are optimistic on the market and very hesitant to short or put on hedges. Like, we're not seeing that on our desk. Is that the vibe you're getting?
Yeah, it's definitely been difficult on the short side, which is not surprising. Again, anytime you see a market rebound after the collapse we saw in March and April, shorting stocks is about as challenging an environment as you get. And as you've said, and we've written about, the market in July, starting July 1, got even more risk on and junky or low quality in terms of leadership. In terms of clients, it's funny, this week I had a bunch of meetings in person, and I would say it was kind of split. One client was kind of, I'd say, in line with your S&P 10,000 call. We were just speculating on, okay, what could make, irrational exuberance or squared come back? Because certainly that's the path we're on right now. Yeah. So talking about all the different positives that could make valuations of the market go to new cycle highs, above 2021. So that was one part of it. The other, those clients that are more, no one's bearish, but I think people recognize what you're pointing to is that it's been a great 3.5 month rebound, but no one's worried about anything anymore. And that makes people nervous. There are plenty of things that could become a risk. So I think people are thinking about looking for pockets of the market, particularly in some of these shorted names that have gone up massively, to perhaps re-engage.
I think that's, certainly what we're seeing. And like, again, we looked at, just compared the crowded short basket, and they added this to some of your work recently. It's just the ARC, and it kind of tracks it very well. And ARC, I think, is up. There's some good companies in there, but it does act a lot like a crowded short, and it's up, I think, like 70% over the last since Liberation Day. So these are significant moves in a very quick time period. So I think any sort of cooling off, and you can get, people quickly unwinding positions. And again, this is with eco data's been fine, employment's been fine.
Yeah.
If anything starts to slow, incremental buyers start to become incremental sellers because maybe they need the money for other things. And, especially if job losses start accruing.
Yeah, I heard a few clients are worried about that. Someone was saying to me yesterday, actually, I was on your phone, and talking about potential near-term negative NFP print. So yeah, I think you speak to 20 people, you'll get 20 different opinions. And that's valid because there's just, the data are all over the place today, but the market's not. The market's broadly strong. And again, I think I would say that is consistent with the decline in spreads we've had. It's consistent with realized volatility that you mentioned being very low, the VIX being low, and people feeling pretty good. I mean, you can't have a backdrop where markets act like that and spreads are not coming down. Question is, what risk is out there that could go away? So again, maybe tariffs end up, not being an issue, and Trump, kicks the can or pivots again. Maybe inflation just goes sideways and CPI doesn't tick up. And, maybe that's enough to get Powell to start to change his tone. So that's that sweet spot, is that if things just kind of economically remain okay and inflation doesn't go up, markets PE are going to go higher. That's the bull case from a macro perspective, because in that backdrop, earnings are fine, then that's good enough. That'll support people taking on even more risk. And, basically until a risk or problem shows up, it's not going to stop.
Right. And I'd say it's like, doesn't that almost encourage higher tariffs? The fact that everything's been totally fine with tariffs at these levels, they go higher, everything's been fine. So that's why I just feel like this August 1st date could be a big negative surprise, just like Liberation Day was a big negative surprise. And again, It's priced just like Liberation Day, non-event.
Yeah.
I think if payrolls weren't on August 1st, this would be like a 50 bip implied move. Right now it's 90 bips, but also your payrolls that day.
We have Lutnick with a new poster in August.
Exactly.
So that's not going to be a good poster.
Like, and you can easily say it's like we've raised tariffs everywhere. We're taking in a ton of money and it has no impact.
Yeah.
Right. S&P at all-time high. Employment's fine. Inflation coming down. Although, arguably.
That's where sentiment today. It reminds me a little bit of late November too, after Trump got elected, when the Russell did hit its high for the last couple of years at least. And similarly, nobody was worried about anything and everyone was looking at all the positives. And again, in and of itself is not a reason to get super bearish. You need a catalyst. But I think at a minimum, it's prudent to start looking for either taking profits on some stocks that are going up purely because of this macro story, which is, the highly shorted stuff, not fundamentals. And if fundamentals begin to matter again, those are the stocks that are at the top of the list to take a hit. I mean, if the market S&P pulls back, 2 to 3%, which is, no big deal, those stocks could be down 20.
Absolutely. And we've had August surprises in the past. It's not unusual to get some August surprises. And for what it's worth, seasonally, September's been a terrible month the last 10 years. So July is the time to be long, especially the first 2 weeks of July. We know that, and if you care, that one of the reasons why, November and July are good times to be long, you have something. I think that there's a technical that happens that around holidays, you have what's called delta decay. So if you buy a 50 delta put, or if, let's say a 40 delta put, one day passes and the market doesn't move, the delta will shrink a little bit. So I hedge on a 40 delta, so I short stock against my put. Now I have to cover a little bit to hedge on a 39 delta. So you can see, when you have holidays and you have low volatility, you're covering part of your short stock against your short put. Creates this sort of nice lifting effect. And that's why the first couple of weeks of July tend to be very strong. And it's more mixed the back half because we had 4th of July. And that's why Thanksgiving around in November, that's why November, if you look, is a pretty strong month. You have this holiday week. So you get a lot of this nice delta decay, which helps boost the market. It's so stupid, but it then tends to work. And I think it really is just these days off that everyone knows about actually do tend to be pretty bullish. I know, but it works.
Hey, Danny, as Steven likes to say, if it makes dollars, it makes sense.
Right. So it's you want to be long the first couple of weeks of July. Unfortunately, those are over, and you want to be long November. That's on just holidays.
We'll add that to our next fund report next year.
Yeah, great. I want to be long on Mondays, I read.
That's right. So I want to circle back to something you and I were talking about at the beginning of the month. To start off July, we saw a sharp pullback in the momentum trade. And that was a intense focus of clients in the first 2 weeks of July. What are you hearing? Are people focused on that still? Because I know it's been it's rebounded. It's been volatile. It's not going straight down anymore. What are you hearing from clients about that?
I think, again, it's more the short side where they're struggling with is what do I cover my shorts? Do I lean in? Do I fight it? And the long ends have been fine. So it's I think this bounce in semiconductor specifically, this semiconductors ripping to new highs, most clients are long semis. And so that's been fine. So I think it hasn't been as painful because what I'm told is that, yes, the shorts are a struggle. It's that people aren't necessarily losing money. They're just not making money. So they're underperforming the overall S&P. And that's, I think, part of what's going on too with put call ratio being so low is that fear of underperformance. I think it's much more painful when you have momentum rolling over and the market rolling over. In this scenario, people tend to run net long. There's very few funds we cover that run net short. So it's just an underperformance issue. Now with momentum bouncing, I think people feeling pretty well set. And I think the bigger risk for most guys and why most people we speak to our position to be a sell-off, like a broader sell-off. And if momentum underperforms on the sell-off, even worse. But during Liberation Day, momentum actually did pretty well. And I don't think people were happy because a market going down 10% in the course of a week is not good for anyone, even if momentum outperforms. So I think it's if you asked a lot of people we speak to, I would say, I'd rather have the market up and momentum underperform than the reverse market down a lot and momentum outperform. So I think people tend to be positioned that long.
Yep. What are you hearing in terms of interest rates? Nowhere has the debate been louder than nowhere do people have stronger opinions than the 10-year bond yield. And realize vol, I don't know where the number is, but I imagine it's collapsed. 10-year bond yields aren't moving really so much anymore. And if you look over the last 2 years, they really haven't moved. So you've had on one side a big camp of people talking about the deficit and how 10-year yields are going to blow out to 5, 6, 7%. And then you've got those that are more bearish or the Fed's going to cut, the 10-year is going to go down to 3 handle. No one's been right on the 10-year.
Yeah, it hasn't done anything. It's just been stuck. We see people much more concerned that 10-year is going to go up a lot than down. I think that would shock people if you got a big 10-year rally. I think the most consensus trade, as we mentioned earlier, is a steepener. I think everyone thinks the deficit's is out of control. The Fed is sort of the Fed is being pressured to cut when they don't need to cut, before inflation is necessarily like solved. And we continue to see like the bond bear. That's the narrative. Long end eventually will go higher. So I think any sort of surprise would be a rally. But to your point, the best trade you could be doing at least for us, so we trade TLT, we don't trade rates, selling strangles. Quietly, that's been an incredible trade that no one, everyone wants to have a strong bond opinion, but, selling an option that it's basically the 10-year's been between 4% and 5%, basically 2 years. And it's broke below 4 a couple times. It hasn't broke above 5, but basically for 2 years, it's been between 4 and 5%. So that's been the right trade, and I don't think people do it. One thing we were kicking around is selling puts on the TLT. So basically saying, I don't think the 10-year is going much above 5, and using that premium to buy calls on gold, with the thought being that if you push out Powell, you'll get the long end to really go up. We already saw that on when it was floated that he was going to be about to be fired. And then whoever gets it put in place, you'd think would be cutting rates. And then Besson obviously has talked about wanting to get the long end not to go up that much. So maybe you have some pressure to actually do like an operation twist or QE. This is like tinfoil hat stuff, to be clear. And so if you do cut rates, you do QE or some sort of a twist where you're buying the long end, dollar gets killed, gold should go up a lot. That was kind of my thought process, so why it could work. To be fair, it's been working regardless. Like that trade's been great. Gold keeps making new highs and rates haven't done anything. It could just be more of the same also, and it could work.
There was that big breakdown of the relationship of 10-year yields or interest rates and the dollar during all the tariff craziness and sell-off. And that has completely joined back up over the last month and a half. We saw rates go down up until the end of last month in June. We hit 420 on the 10-year, I think at the low, or 422. Mm-hmm. That was the low in the dollar. And rates are up, the dollar's up. And so those are moving together. So yeah, I've argued the view on that the deficit is having any influence on the dollar or the 10-year yield, I think is hard. It's a good story. And it's obviously something people are talking about, but I don't really see it as being a driver, because if the deficit's a big issue, you'd see higher yields and weaker dollar. And we only saw that for a very short period of time right after Liberation Day, which again, it could have been a result of that rather than anything else. But now we're seeing rates go up, dollar go up. So to me, what's driving that whole story, once again, is just the employment data and the inflation data, and ultimately, what the Fed's going to do. And like you said, the last 2 NFP reports were better than expected. CPI was a little higher. So the dollar quarter to date, dollar's up, rates are up. And I think that's going to continue.
Yeah, and then that's where you get some of this risk on turns into risk off if it continues. I think right now, we're still in the sweet spot. You could point to these crypto catalysts. You could point to all these bespoke events, and then what? And that's the whole thing. It's like we have earnings. We'll see how earnings go. But so far, they've been, I'd say, mixed at best. And if we start to see any sort of margin pressure around tariffs, everyone's already there. Everyone's already long.
Danny, this has been incredibly insightful. Your insights on the market and what's driving things always amazes me. I love how you were putting the mechanics behind the seasonality moves. Thank you so much for being here. Just a few final thoughts. You want to pull it all together?
Yeah, I think it's near term. I can answer your point. Credit spreads tight, volatility low. The positive catalysts have hit. There's one more next week. I think on this AI summit, we'll see how that goes. But inexpensive to hedge, had a massive short squeeze. We like Russell downside out to August, maybe September. Longer term, if some of these policy tailwinds hit, who knows, S&P 10,000, 2027.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.